Hi, everyone. Thank you for having us here today. I'm Ainsley, and I'm here with Saul and John, and we've performed a thorough analysis of Helen of Troy and are going to recommend that you sell. So, going into our agenda for the day, we're going to talk about business overview, followed by investment overview, investment risk, ESG, and then our conclusion. So, let's hop right into the business overview here. Helen of Troy operates in three segments right now: home and outdoors, health and wellness, and beauty. But with the introduction of Project Pegasus, they'll actually be combining health and wellness and beauty, which comes with a lot of risk, as that's a lot of reorganization. Um, Looking at how much revenue each segment generates for the company, home and outdoors is their biggest segment, generating about 39% of the revenue they had in fiscal 2022, 33% from health and wellness, and 28% for beauty. However, with Project Pegasus, they will be divesting some assets in beauty, so we can expect that number to be a little bit lower in the future. Next, John is going to talk about the competition.
Thank you, Ainsley. So here we just have some quick descriptions of some of their biggest competitors that we chose for our comparable analysis. On the next slide, we'll go a little bit more in depth with some multiples. But just to start here quickly, we have the Edgewell Personal Care Company that manufactures and markets personal care products. So more along the lines of Helen and Troy's health and wellness section. We have Hamilton Beach Brands Holding Company, which designs and distributes small electric household and specialty houseware appliances. So more in line with the Honeywell brand within Helen of Troy. We have Spectrum Brand Holdings, which is just a consumer products company worldwide. So some of Helen of Troy's holdings, such as Hydro Flask, fall more in line with that. And lastly, we have Coty Inc., which markets and sells beauty products worldwide. Yep, so here we have some of the relevant multiples and all of the peer companies that we chose for our comparables analysis. As you can see here, we've broken out EV to sales, EV to EBITDA, EV to EBIT, and their price to earnings ratio. Down here at the bottom, you'll see Helen of Troy's multiples, and just under that, median multiples of the peer group. And as you can see, Helen of Troy, by pretty much any metric, trades at a premium to their peers. We think that's mainly due to them being a more diversified business in terms of their revenue segments than many of their other peers here. But we think this premium makes them slightly overvalued. Yep, and we'll be continuing on with the investment overview. So here we have the assumptions for our discounted cash flow model. As you can see, we have relatively conservative revenue growth assumptions with a 50 basis point hike for each year, the projection period. We think this is largely in line with Helen of Troy's historical performance, excluding the few years around the pandemic where there was some dislocations. We have a 75 basis point hike per year for cost of goods sold as a percentage of revenue, mainly just due to cost inflation for inputs that we think will continue to show a little bit of margin compression there. Our other expense accounts are relatively flat as a percentage of revenue with a few small hikes. And as you can see there at the bottom, our EBIT margin is staying relatively flat, around 30%. Yeah, so to continue on with our discounted cash flow valuation, we use terminal EV to EBITDA multiple of 9.5 times, which falls in line with the median values of the comparable companies. Weighted average cost of capital, 7.2%. As you can see, we have some of those other inputs there on the left with the risk-free rate, the risk premium, and their beta, which gives us an implied value per share of $91, approximately a 20% discount to where it currently trades. And we got 90% of that value, as you can see over there on the right, was coming from that terminal value. And the nature of terminal value being farther out in the future might make these cash flows even riskier than just the value per share.
And now taking a look at investment risk, we're going to start off with the short-term risk of Helen of Troy. And the first point that I would like to make is there is a reduction of free cash flows. And a main driver behind this is increase in interest payments, as well as inflation. And because of inflation and of supply chain distribution issues due to the COVID-19 pandemic, Helen of Troy did not have as much inventory in 2019 and 2020, but now with supply chain distribution increasing, Helen of Troy has an excess of inventory, which means that their inventory turnover is a lot lower currently than it has been in the past, as well as there has been a reduction in return of assets. And passing it back on to John to talk more about the long-term risk.
Yeah, so as you can see here on the right, we have a chart of the federal funds rate, which flows into our first point, which is the interest rate risk that Helen of Troy has. As you know, they have multiple debt facilities that are SOFR plus a floating rate. And the high level of leverage that they currently have is putting them at risk at paying an even higher floating rate, especially as federal funds rates continue to creep up. Another big point is their dependence on acquisitions for growth. A lot of their revenue growth has come from the acquisitions they made in the past 5 years. And we think if they want to continue to use both cash and debt to finance those acquisitions as interest rates remain higher and they use a lot of floating rate revolvers and other debt facilities, it's going to be harder and harder for them to find accretive acquisitions that will continue to help them grow. And Ainsley will touch a little bit more on this when she talks about ESG, but they have had some EPA compliance problems in the past year and some related expenses to go along with that. So I'll pass it back to Ainsley.
Awesome. Thanks, John. So let's hop into ESG. We'll start with environmental. Helen of Troy has a goal set for fiscal year 2030 to reduce their greenhouse gas emissions by 46.2%. They also, a lot of the brands that they own have their own initiatives and programs for the environment, including 1% for the Planet by OXO, which is where they donate 1% of their revenue back to nonprofit organizations that focus on the environment. There's also Parks for All by Hydro Flask, an initiative focused on providing green space for everyone. And so far, they have donated $2.5 million to the cause. Next, going into social factors, Helen of Troy does have a code of conduct for all of their employees and requires reports from their supply chain vendors on labor practices to ensure that they're fair. They also have several employee wellness programs in place right now, including financial responsibility programs and childcare. And lastly, they have all of the safety training and equipment needed for all their employees. So going into governance, we have audit and compensation committees. And recently, they've also added a senior director for global ESG and an ESG task force to widen their ESG within the company. And now, as John mentioned, we do have that EPA compliance issue. So it's the Environmental Protection Agency, and Helen of Troy has actually incurred costs of $17.4 million due to some packaging concerns. So that's definitely something we want to keep an eye on, given that the rest of their ESG is fairly positive. So with that, hopefully our analysis has helped you guys understand where we're coming from with our recommendation to sell. Thank you. Questions?
I'm going to let the judges prepare their questions, and then I'll start the time for 10 minutes as soon as they ask their first question.
Perfect.
I think in your intro, you mentioned the risk of the reorganization. Maybe you could go a little deeper there. What do you see as the potential risks of collapsing 3 business units into 2?
I think it's just risky because it's a big move going from 3 segments to 2 segments. So just combining that, you're going to have to change your operations up a little bit. I think it's just risky going into that, not really knowing how what the outcome is going to be.
To add on to that, when you're combining 2 things, you might have some cannibalization going on with some other products. So that's another risk that they also need to consider.
We also just kind of viewed it as kind of a signal that they're maybe winding down beauty a little bit, not putting as much of an emphasis on it, especially as we saw in like their latest 10Q, they've divested a lot of their beauty assets.
What about some of the cost savings that would come around with that reorg and that consolidation?
Yeah, I mean, that is something they mentioned, that they will see significant cost savings as a result of this reorganization. So that's definitely probably going to be a positive influence, especially from a cash flow perspective. So I think it's very understandable why they're doing it, because I think they said they'll save, or they'll be able to reduce the cost of goods sold from the beauty segment by almost 20%. So definitely, yeah, a positive aspect.
You talked about their being dependent on acquisitions for growth. What does their overall debt level say about their capacity for acquiring additional?
Yeah, so they are pretty heavily levered, especially when looking at some of their competitors. So that probably doesn't leave a whole lot of room for acquisitions on the horizon, just due to they're probably not going to want to issue more stock or use the cash that they still have on their balance sheet to go out and buy a company, especially in such a market environment where you probably don't want to be offering new shares. So it definitely will hinder their ability to make acquisitions going forward.
How do you view their past acquisitions? Have they lived up to expectations of when those deals were done?
I think some specific examples like Hydro Flask and Osprey have definitely done well and been accretive acquisitions. So I would say they've done a pretty good job so far. And I mean, they've been divesting some of their beauty assets that aren't performing as well. So I'd say overall on acquisitions and divestments, they have been doing a pretty good job.
I'm adding on to that one thing we noticed when we were looking into the companies, including Hydro Flask, is that they seem to have a little bit of a pattern of acquiring like fad companies. So Hydro Flask brought in a lot of revenue for them, and Osprey, those are two really big brands that they own. But Hydro Flask has kind of fallen off since they bought it in 2016. Yep. So that's just something we've noticed because now there's a lot more competition coming in with like Stanley Cups and Yetis.
You laid out a pretty granular expectation for cost of goods sold rising as a percentage of revenues. What underlies that assumption? Why should their costs be going up in the next 4 or 5 years?
Yeah, just the main assumption there was cost inflation they're seeing in many of the input items for the products that they manufacture, and just trying to normalize that over our projection period.
So you're assuming that the current inflationary environment persists for an extended period of time?
Yes, in a way. We're trying not to just model that all into the front because that has valuation implications. But I mean, we are assuming there's going to be some level of inflation for some time.
Okay.
Maybe not at the same high level that we're seeing right now.
Are they sourcing from China? Any impact on that with all the political issues that are arising currently in China? And I think that's one of their supply areas, right?
Yes, it is. I don't know if they're seeing outsized impacts as much as maybe a company like Nike or Tesla that are heavily dependent on their factories in China. I didn't see it being a big topic that they were focused on risk-wise, but I feel it's definitely a risk. But if they should be able to move their operations as other companies are doing if it really becomes a burden on their ability to manufacture products.
When I look at your competitive company analysis, you have quite a few companies that are there. How do these comps compare to Helen of Troy?
Yeah.
When you think about it from a growth and profitability standpoint, is there one or a handful that are most comparable?
Yeah, so we did kind of struggle. A lot of those companies will have one of the segments, so say home or outdoors, health and wellness, or beauty. It was hard to find comparables that included all of those. And most of them are growing around that high single digits range, and most of them do have better returns to capital than Helen of Troy. I mean, it's kind of iffy, but it is kind of all over the place just because we have some beauty companies, some home and outdoors, some health and wellness, and some of them have different industry risks than each other. So yeah, I mean, ideally we would have had better comparable companies, but yeah.
Yeah, I think a lot of the companies we were trying to compare Helen of Troy to are a lot bigger because they're just in one segment. So I know we found like Tupperware kind of comparable to OXO, but Helen of Troy just has OXO and Tupperware is just like a lot bigger than that company. So I think that's another thing we found that like in the beauty world too, there are just really big players, and Helen of Troy just has a really small percent of that market share.
Where are the operating margins? Which segment has the highest operating margins?
Do you know that, Ainsley?
No, we would have to get back to you on that one.
Could you also talk about your view of revenue growth going forward? You have it accelerating somewhat. Just interested to
Yeah.
understand the
Yeah,
assumptions there.
I mean, they have seen a slowdown in revenue, especially after the last year, just because of how inflation's hitting the consumer and stuff like that. But we think it's going to pick back up more to levels you saw from maybe the past decade before COVID, when it's more in that 6 to 7% revenue range. And we just kind of want to slowly hike it up to there, just partially to be conservative, partially to be more in line with what historically how they've performed.
Got it. Okay. Did you assume acquisitions in that?
We didn't model that in, no.
Okay.
What would cause you to change your recommendation from a sell to maybe a neutral in terms of some of the factors that you talked about, the restructuring or the increased cost, perhaps?
I think a big one would to kind of look at their inventory, because currently they have an excess of inventory. And for me, looking at a company, when inventory is a big driver of their revenue, they kind of need to, get more inventory to be able to sell more of their inventory. So I think if they were able to increase their sales, then maybe I would consider it a hold.
Yeah, and to add to that, I think seeing some organic growth from maybe some more internally developed products would be what we want to see instead of all the acquisitions that they're doing. I'd say that would be the main thing that would allow us to change our view.
I think you had some concerns about their ability to pay the interest and the potential trajectory of the interest rate going forward. Are there other things they can do to help manage that risk, refinance, go to a different debt source? Like, how do you
Yeah.
think about mitigating that interest rate risk?
Yeah, I mean, I think they do already try to mitigate it. They do deal with interest rate swaps, but obviously as federal fund rates go up, those swaps get more expensive. So not necessarily an ideal way of dealing with it. Ideally, you'd go to a different lender, get a fixed rate. They can't really do that right now, and you wouldn't probably want to refinance where rates are at. So I'd say they're a little bit stuck, but I mean, their interest and coverage ratios look decent enough to where I don't think interest payments are going to have a very material impact on their financial health. But as Saul kind of mentioned earlier, it might still have some impacts on their ability to generate cash flow.